If you're looking for an investment that allows you to earn stable returns, diversify beyond the stock market, and at the same time support real European businesses, then crowdlending is something you should definitely know about. Crowdlending, also called peer-to-business lending, allows everyday investors to finance small and medium-sized enterprises, or SMEs, across Europe by providing loans directly to companies instead of buying shares or trading stocks. And this is important because SMEs are the backbone of the European economy. They create most jobs, drive innovation, and keep local economies alive. Yet many of these businesses struggle to get financing from traditional banks. Banks often require long operating histories, strong collateral, and complex paperwork. For many growing companies, that's simply not realistic. This is where crowdlending platforms come in. They connect investors like you and me directly with businesses that need financing. The process is simple. A company applies for a loan on a crowdlending platform. The platform performs credit analysis, reviews financial statements, and assesses risk. If approved, the loan is listed for investors. You can usually start investing with as little as 50 or 100 euros. When the business repays the loan, you receive your money back along with interest. Instead of guessing where stock prices will go, you're investing in real companies with real cash flows. The businesses financed through crowdlending platforms come from many sectors. Manufacturing companies, logistics firms, restaurants, renewable energy developers, farms, IT companies, and service providers all use crowdlending to grow their operations. Loans are often used to buy equipment, expand production, finance working capital, or refinance existing debt. That's why crowdlending is one of the most tangible and understandable forms of alternative investing. Now let's talk about returns. In Europe, crowdlending typically offers annual returns between 6 and 12%, depending on the risk level of the borrower, loan duration, and whether the loan is secured. Loan maturities usually range from 6 months to 5 years, with most loans falling somewhere between 1 and 3 years. Many platforms offer fixed interest rates and regular monthly payments, which makes crowdlending attractive for investors looking for predictable income, not just long-term growth. Of course, crowdlending is not risk-free. The main risk is that a business may face financial difficulties and stop repaying the loan. Economic downturns can also impact small businesses more than large corporations. And there is always platform risk, meaning the platform itself must remain operational to service loans properly. Yet for regulated platforms, this risk is minimized. To reduce these risks, platforms apply credit scoring, analyze financial data, and often require collateral or personal guarantees. Some loans are secured by real estate, equipment, inventory, or receivables. But diversification is key. Successful investors spread their money across many companies, countries, and sectors. One major advantage of investing in Europe is regulation. Many platforms now operate under the European Crowdfunding Service Providers Regulation, which significantly improved transparency, investor protection, and risk disclosure. Compared to the early days of crowdlending, the market today is far more mature and professional. Let's briefly look at a few important platforms in the European crowdlending space. Across Europe, there are many regulated platforms offering access to SME financing through different crowdlending models, each with its own balance of risk, return, and maturity. For example, Colin Crowdfund is one of the leading platforms in the Netherlands, focusing on loans to establish small and medium-sized businesses. Investments typically offer annual interest rates in the range of roughly 5 to 9%, often supported by collateral or personal guarantees, with maturities usually between 1 and 5 years. In France, Anaxigo provides access to both SME debt and equity investments. On the lending side, investors can participate in structured loans to growing companies, where expected returns are often in the 7 to 12% range, depending on project risk, structure, and duration, with maturities commonly spanning 2 to 5 years. The UK market is represented by platforms such as Folk2Folk, which specializes in secured lending to British SMEs. Many loans are backed by property or other tangible assets, and investors typically target returns of around 6 to 9% per year, with loan terms often ranging from 1 to 3 years. In Southern Europe, Capitalia offers access to private debt investments in SMEs, including financing for growth and expansion. These investments usually target mid-single to low double-digit annual returns, roughly 6 to 11%, depending on risk profile and maturity, which often falls in the 2 to 4 year range. Germany and Austria are covered by platforms such as Conda, which connects investors with SMEs across a wide range of sectors. Debt investments on Conda commonly offer returns between 6 and 10% per year, while equity-style investments aim for higher long-term returns but come with higher risk and longer holding periods. So why do investors like crowdlending? Because it offers exposure to the real economy, generates predictable interest income, and has relatively low correlation with stock markets. Entry barriers are low, and investors can actively support European businesses while earning returns. Crowdlending often sits somewhere between bonds and equities in a well-diversified portfolio. But success in crowdlending requires discipline. Investors who perform best usually invest in dozens of loans, diversify across platforms and countries, and reinvest interest payments. To sum it up, crowdlending is a powerful way to invest in European small businesses, earn stable returns, and support economic growth. But it requires understanding risk, choosing platforms carefully, and diversifying properly. On crowdinform.com, you can compare crowdlending platforms, explore SME-focused investments, read user reviews, and use AI-powered tools to better understand platform and borrower risk. If you want to learn more about crowdlending, alternative investing, and impact-driven finance, make sure to follow and subscribe to Crowdinform.